I think the way you've got to look at your wealth nowadays is not to accumulate any more wealth. Those days are done. What you've got to do is you've got to focus on protecting what you've got. And you have to think very, very hard about what the values of the things you have are going to be in the future. Equities, I mean, as I've said, that is already, the valuation is so incredibly stretched with bonds. And now we're talking about bond yields rising even further. The equity market is going to crash. Firm prediction. People think property. Well, I don't know about in over on the other side of the pond, but over here in the UK, property values depend on financing through mortgages.
Markets frequently appear stable on the surface, but there is underlying fragility. The cracks are beginning to appear as central banks, debt, and currencies are strained to their breaking points. The current gold price pattern is an indication of severe stress in the global financial system, not just another price trend. Strong momentum is brewing beneath the charts, as indicated by a tightening pennant with rising support. If this structure breaks, it may signal the beginning of something far more dramatic. Major economies' rising bond yields speak for themselves. Quietly, investors are switching from paper promises to real physical assets. Experienced market strategist Alasdair Macleod, who has studied cycles of speculation, collapse, and recovery for decades, provides crucial clarity at this time. He reminds us that central banks have been attempting to use artificial tools to cover unmanageable debt since the 60s. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing.
Why do you say that this thing could unwind within weeks? What makes it so urgent? Can they not kick the can down the road a bit further?
Well, I think one of the problems in this is that if it was just one nation in trouble, then I think the others could rally round. You would get, I mean, let's say it was a problem for the Bank of England, which it is actually. But nobody else had quite that problem. You would have swap lines being, sort of quietly put in place and all the rest of it, because other central bankers will be aware of the problems. But this one is everywhere. This problem is everywhere. It's not just something starting somewhere, and maybe if it's mishandled, it's going to have knock-on effects elsewhere. It's not like that. It is everywhere. And I mean, at the end of the day, there's the old market phrase. You would say the markets always win out at the end. And yeah, okay, we've been kicking the can down the road, really, since the 1960s. And the first sort of blip in that was the end of Bretton Woods. I mean, it started off with gold pool failing and all this sort of stuff. They're trying to sort of keep the thing up, as it were. And they've kicked the can down the road, I mean, they've devalued the dollar measured against real money. I mean, like it's lost 99% of its value virtually. That's what's happened to the dollar, and it's even worse if you look at sterling. I mean, we have a coin which is the sovereign, and the sovereign was once the most common gold coin in the world. And when you look at a Bank of England note, it says, from the chief cashier, I promise to pay the bearer, if it's a £10 note, £10. Yeah, on demand. Now that £10 is 10 sovereign coins. A sovereign coin today is £600. So you can see what's happened to sterling over the years. I mean, basically, these currencies have gone down and down and down. And what we're looking at now is an acceleration into oblivion. And it's taking all forms of credit with it. I mean, everybody thinks wrongly that the Fed can always control interest rates and introduce yield curve control and things like that. That is not the case. In normal times, when things are not too challenging, yes, they can do that. But we now have a situation where debt to GDP in the US is well over 100%, 125% or whatever, depending on what your view of GDP is. We've got high GDPs all the way around the world in all the G7 countries now. We're looking at an average of 100 or maybe slightly more. I mean, France is about 110, I think. UK is about 100. Germany is a bit lower, but they've just raised their debt limits because they're going to spend money buying military equipment off the Americans to expend in Ukraine. they're all very highly indebted, and these are debt traps. I mean, by definition, when you find that economies are stagnating and debt is still growing, it's debt which is not being deployed productively by any stretch of the imagination. You're looking at something which is actually just eventually going to collapse. Central banks can delay things. Yeah, they have delayed things. But I think this one is getting out of their control. I really do. I mean, the Fed has already effectively admitted that it can't fund out along the yield curve. It's tried to, and found that auctions have been disappointing, to use the recurring phrase. The only funding they can really do for the U.S. Treasury really is short term. I mean, it's less than 5 years, certainly less than 2 years, and really it's a reliance on T-bills. And this is why there was this debate within the Fed, including input on compliance vis-a-vis Basel III, as to whether they could get rid of the supplementary leverage ratio, or reduce it anyway, which would give the banks room to buy more T-bills. I mean, the banks are willing to do it because all the regulators tell them that the risk-free investment is a T-bill, and the banks don't want risk. They see things out there which I don't think they would really want to admit to. Occasionally, you get Jamie Dimon standing up and saying something which is rather controversial, but I reckon that the bank's internal research on the state of the U.S. economy, I think, shows that things are just not good. So they don't want to lend money all around the country, and I think this is partly why they seem to be quite happy to puff up financial markets by directing bank credit in that direction. And the result is you've got over $1 trillion, according to FINRA, being lent to margin players in the equity market. This is very, very much end of era stuff. It really is.
The financial landscape of today has evolved. The emphasis is now on preserving what you currently have rather than pursuing unending expansion. The days of making money by continuously raising the value of assets are coming to an end. The foundations of the global financial system are beginning to crumble. Bond yields are rising and stock markets are expensive. History demonstrates what can occur in these circumstances. When measured in sound money, traditional assets like real estate can lose nearly all of their value when currencies crash. During the hyperinflation of the 20th century in Germany, huge properties that were formerly valued at fortunes were now worth only a few ounces of gold. While the middle class was destroyed, those who owned real money gold were able to purchase material possessions for pennies on the dollar. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
I think the way you've got to look at your wealth nowadays is not to accumulate any more wealth. Those days are done. What you've got to do is you've got to focus on protecting what you've got. And you have to think very, very hard about what the values of the things you have are going to be in the future. Equities, as I've said, that is already, the valuation is so incredibly stretched with bonds. And now we're talking about bond yields rising even further. The equity market is going to crash. Firm prediction. People think property. Well, I don't know about in over on the other side of the pond, but over here in the UK, property values depend on financing through mortgages. But also, if you look back to previous currency collapses, and I want to use that phrase rather than hyperinflation, currency collapses. I think that one of the best documented was Germany in 1922 to 1923. And you could buy a house in Berlin, 6 bedrooms, decent part of the city. 1923, you could pick that up for $100. And that house, $100 was slightly less than 5 ounces of gold, because the exchange rate at the time was 20.67. That is the difference between the purchasing power of gold and a collapsing currency. I don't know how many billions or trillions of Deutschmarks you would have to pay to buy a house like that. But in gold, I mean, its value just completely collapsed. And this is why the inflation kings, Hugo Stinnes at the time, was able to buy, he had something like fully 25% of the German economy under his belt. He was buying country estates and all the rest of it for nothing, absolutely nothing. Why? Because all the sort of the bourgeoisie, the people are socialists in this country are trying to kick downstairs. They were all impoverished. They were literally starving. So you've got to think very hard about how you protect yourself in a currency collapse, because that is actually what the bond markets are now telling us. And you have to understand the difference between credit and real money. You've got what's called corporeal money, which is physical money, which you possess, which has no counterparty risk. And that is metallic. It is gold and possibly silver. And you've got incorporeal money, which is credit. It doesn't exist. It's got no presence. That is the bit that is collapsing because it's no longer tied. The whole point about a currency with a gold standard is that the currency becomes a gold substitute. It gets tied to the value of gold. So you can increase the money supply particularly if you use it to increase production, to finance the increase in production, as opposed to finance the increase in consumption. But basically, that's what it is. I mean, when you get the discipline of gold in there, then you find you don't get prices rising. Why are prices rising? Because the currency is going down.
Alasdair Macleod makes it plain that the days of continuously accumulating wealth are finished. Now, safeguarding your existing riches is a true challenge. Bond yields are rising, stocks are dangerously inflated, and property values that depend on low-cost mortgages are in jeopardy as funding becomes scarce. History serves as a stark cautionary tale. Once valuable, Berlin homes could be purchased for the equivalent of a few ounces of gold after Germany's currency collapse in the beginning of the 20th century. Paper money was useless, and entire businesses and estates were essentially given away. The middle class was destroyed, while those who owned real money gold were able to purchase assets for almost nothing. According to Macleod, this is the lesson we can't overlook today. Inflation is characterized by declining currencies rather than rising prices. The bond markets are already alerting us to the fact that we are not only dealing with inflation, but also a complete currency collapse. The type of money you have will determine whether you survive or fail. Like paper money, Macleod's final point is straightforward but urgent. Cease interpreting inflation as an increase in prices and instead see it as a collapse of currencies. You must switch from paper illusions to real, long-lasting money like gold and silver if you wish to safeguard your future. He claims that helping people comprehend the true situation before it's too late is his goal. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn